In this section, we continue to discuss our first objectives of applied corporate finance and look at uh, whether we can have any other motive other than the objective of maximization of the share price or maximization of the firm value for any particular firm. Now, as we look at this as an objective, we're going to first lay down our key and major objective with respect to corporate finance, and then see whether that holds in real life. Right. So we have to define the key objective function of any corporate in terms of trying to lay down the foundation of the corporate finance curriculum. Right. Now, the objective in decision making in traditional corporate finance is essentially to maximize the value of the firm, right? And a more specific objective is to maximize stockholder wealth. What do we mean by this? Essentially, if you have the firm value, remember that the firm value is the value of debt plus the value of the equity. Assuming that the debt value is fixed, in order to maximize the firm value, you have to essentially maximize the equity value, right? So the more specific objective that comes up in terms of maximization of firm value is essentially maximizing the stock price in case the company is listed. If it is not listed, you just try and maximize the total overall value of what the equity of the company is worth. So that's going to be our more specific objective, which is we have to essentially try and maximize the stockholder wealth, right? Now note that in a corporate, the stock owners can be different from the managers. In fact, in most of the cases, for most of the major firms, the managers are actually different than the stock owners, right? And then obviously there is going to be some sort of a friction in terms of what is the management trying to maximize. And the idea in corporate decision making is that managers will be the ones who will be making these decisions. So will they be able to maximize the output such that the stock owner's wealth is maximized? That objective is what the eventual decision point in corporate finance comes back to, right? Now, if you think about it, there is a little bit of a criticism around looking at stock prices as the sole objective, right? Let's quickly recap what we were looking at, which is we have already seen that currently if a company has assets, there are certain assets which are already in place. These are the assets which the company has already invested into. It is easy to value these. We have a value available for these. They are available in the market, right? There are other growth assets, which is what will you create. This value is the creation of value from future investments, right? So that's what the company is going to evaluate. Then we have a fixed liability, which is debt. It has to be given out at a certain maturity, and that's fixed for the firm. So in a sense, if we are trying to maximize this, we want to maximize the asset value such that the firm goes. Within this, the current asset value is probably the assets which are already here are kind of fixed. So we want to maximize the value we derive from future investments or growth assets. In turn, that would also maximize mathematically the value of the equity because debt is fixed. Now remember, we are assuming that the debt value or the value to debt holders is fixed here. In real life, we will have to relax that assumption, and we'll look at examples. How do we relax that assumption, right? Now, obviously, there is going to be some sort of a criticism of this. Traditionally, stock prices are assumed to be sort of capitalistic as a motive. So people don't like the idea of only maximizing stock prices, right? Why is that so? Many critics believe that the objective of maximizing stock prices is not in cohesion with employee welfare. So for example, when some companies announce job cuts or fire employees, stock prices end up going up, right? And that's because the stock market believes there is rationalization of costs, right? So it typically believes that a company, in order to maximize the stock price, will try and maximize eventually maximize profits, and that would essentially mean to cut costs, and that cannot be in tandem with employee satisfaction, right? That's one criticism. We'll come back to this. Another criticism is that in order to maximize stock prices, you will have to care less about customers. Your sole motive would be profit, and hence you would have to care lesser and lesser about your customers. There is also a general criticism that in a bid to maximize stock prices, the company will care less about society in general, right? So essentially, you will not be a good social citizen as a corporate, and you would try to use resources or maximize the use of resources. In a sense, you are trying to maximize resource depletion, right? For example, if you are someone who's a mineral water manufacturer, you might actually maximize the depletion of groundwater in the area your factory is in order to maximize your profits today, right? Now, there is some merit to this entire criticism, but what is the reality is that most of this criticism serves a short-term objective for firms. So it is not to say that firms don't resort to such activities, that they don't cut costs in terms of not taking care of employees or not taking care of customers or trying to not